Hey everyone, welcome to this explainer. Pull up a chair, take a nice deep breath, and let's just get grounded for a second. Today, we're going to sit down together and intentionally deconstruct that massive wall of stress you've probably been feeling about the Unit 4 Topic 1 synthesis problems. And honestly, right off the bat, I want to assure you that anxiety you're feeling right now, it is incredibly common. But by the time we're done here, we are going to completely neutralize it. Look, I know the last 2 days in class have been, well, incredibly tough. You've been trained all year to look at a neat, perfectly balanced trial balance, right? So when you open an exam paper and are suddenly hit with fragmented ledgers, contradictory emails, and just raw footnotes, it's completely intimidating. It feels totally unstructured, unfamiliar, and frankly, a bit overwhelming. But here's the thing. I want to reassure you right now that seeing a messy page of data is absolutely normal in this unit. And more importantly, panic is unnecessary. Why? Because these are absolutely not traps designed to make you fail. They're just clues. Underneath all that chaotic presentation, it's literally the exact same accounting you've been doing beautifully all year long. Section 1. The Forensic Auditor Mindset, Solving the Puzzle. To conquer this, we just need to completely change how you see your role when you walk into that exam room. Okay, let's dive right into this mindset shift. You need to step completely out of the shoes of a routine bookkeeper. The one who panics at messy, unadjusted data. Instead, I want you to step into the mindset of a senior forensic auditor. Think about it. An auditor doesn't expect the data to be perfect. Actually, scratch that. They expect it to be flawed. They actively hunt for specific clues left behind by mistakes. Picture this. As an auditor, you're simply walking into a messy office. A junior staff member has left behind a disorganized pile of papers, maybe some half-finished journal entries, and a bunch of unadjusted ledgers. Your job isn't to start from scratch. Your job is simply to hunt down the specific errors that are well-meaning but kind of messy junior bookkeeper left behind and just calmly fix them. Section 2. The QCAA Perimeter Map. Know your boundaries. What's really interesting here is how heavily the syllabus actually protects you. See, as your teacher, I am legally restricted by the QCAA syllabus to assessing only these 4 specific buckets of balance day adjustments. That's the whole shebang. Number 1, accruals and deferrals, so simple calculations for prepaid or accrued expenses. Number 2, credit and debt management, dealing with bad debts and provisions. Number 3 is non-current assets, specifically straight-line and diminishing balance depreciation. And finally, number 4, inventories, like write-offs or the lower of cost and net realizable value rule. That's it. And because we know this perimeter, we know exactly what tools to bring. For example, within that credit and debt management bucket, you just need to apply standard, familiar rules. A classic one is the net difference method for doubtful debts. Instead of blindly wiping a ledger clean and starting over, which please don't do, you just calculate the difference between the unadjusted balance and your target closing balance and adjust for that exact amount. It's just simple, focused math. So the absolutely crucial point I want you to remember whenever you feel anxious staring at an exam paper is this. If it is not on this strict perimeter map, it cannot come to get you. No way. The chaos is bounded. You just have to identify which of those 4 buckets you're actually looking at. Moving on to Section 3, Visualizing Clues, Messy Bookkeeper Errors. Let's move to some actual evidence and see what these unstructured clues look like out in the wild. Okay, this brilliantly illustrates the chaos you're going to face. On the left, we've got Jane's raw email instructing that the provision for doubtful debts needs to be 5% of accounts receivable. But right next to it, the junior bookkeeper's journal extract shows an adjustment of just $400. The raw data completely contradicts the journal entry. This is exactly what causes panic, but as an auditor, you know exactly what's going on here. That flawed $400 journal entry isn't a trick. It's what we call a conceptual error. The junior bookkeeper violated an accounting principle. They looked at an accounts receivable balance of $21,000, knew they needed a 5% provision, but then completely misapplied the net difference method we just talked about. They didn't account for the existing unadjusted balance properly. Your job? Just spot that error and recalculate the correct adjustment. Easy. Here's another clue, this time from the accruals bucket. We have a raw footnote stating wages are $2,000 for a 5-day working week paid on Friday. But June 30th falls on a Thursday. Next to it, the bookkeeper recorded a conceptually flawed accrued expense of $400. They literally just arbitrarily threw a single day's wage in there. As an auditor, you do the real math. Think about it. $2,000 divided by 5 days is $400 a day. 4 days have passed by Thursday, so the true accrual is $1,600. Boom, you caught the error. Section 4. The domino effect. Tracking downstream. Once you identify that root conceptual mistake as an auditor, you just have to follow the math downstream. We call this the domino effect. When you track a conceptual error in a journal entry, it allows you to easily fix the cascading consequential errors in the financial statements. It's like a chain reaction. If the accrued wages were wrong in the journal, then the expenses in the statement of profit or loss are wrong, which means profitability is wrong, which ultimately means the liabilities in the statement of financial position are wrong. And I really want to emphasize this definition. A consequential error is just the natural mathematical fallout of the bookkeeper's original conceptual blunder. It is not a brand new problem you have to solve from scratch. If you fix the root journal entry, the downstream mathematical fix is pretty much automatic. Notice how easily we can map the flawed treatment against the correct treatment across the statements here. Once you know the junior bookkeeper messed up the provision for doubtful debts, you simply cross out their flawed numbers and drop your corrected, audited figures right into the expenses in the balance sheet. You're really just cleaning up the dominoes they knocked over. Let's move to the non-current assets bucket and see how this builds. The exact same domino effect applies here. Look at the asset register, 20% diminishing balance. But the junior bookkeeper incorrectly calculated that percentage on the original historical cost instead of the net carrying amount. It's a classic conceptual error, right? So, as auditors, we just cross out their flawed $6,800 depreciation entry, calculate the correct diminishing value, and let that flow downstream to correct the final net worth of the business. Section 5. Foundation is solid. Trust your training. As we wrap up this explainer, I want to leave you with a profound sense of confidence. Because the truth is, unstructured data is just the exact same foundational principles you've been successfully executing all year. It's simply disguised as a messy puzzle. The math hasn't changed, the rules haven't changed, literally only the presentation has changed. Keep this quote in mind when you sit down, open that exam paper tomorrow, and see a chaotic mix of emails, registers, and flawed journals. Just remember, you know the 4-bucket perimeter. You know the foundational principles. The syllabus protects you from absolutely anything outside of those bounds. You aren't a panicked bookkeeper. You're a senior forensic auditor, and those mistakes are just breadcrumbs waiting for you to find them. So when you walk into that room tomorrow, take a deep breath, pick up your pen, and ask yourself, what clues am I going to uncover first? Are you ready to audit?